Silver didn't fall because people suddenly stopped believing in it. It didn't fall because inflation vanished overnight. It didn't fall because debt problems were solved. And it didn't fall because physical silver suddenly became unwanted. That's what made February 2026 so confusing for many people. On the surface, nothing looked broken. Governments were still borrowing. Living costs were still high. And long-term risks hadn't disappeared. Yet silver dropped fast. Not slowly, not step by step, but all at once. When moves like this happen, the mistake most people make is looking for a single dramatic headline. A war, a collapse, a shocking announcement. But professional markets rarely move that way. They move because of pressure, and pressure builds quietly long before price reacts. This drop didn't come from weakness inside silver itself. It came from stress somewhere else in the financial system. Silver simply reacted first.
Silver prices continue to slide amid a strong dollar.
Rising interest rates are also
And most viewers were told a familiar explanation: a stronger dollar, interest rates staying higher for longer, cooling industrial demand. Those explanations sound logical, and they are not completely wrong, but they don't explain the speed. They don't explain why silver fell so suddenly instead of gradually. Markets don't crash on information everyone already knows. Known information gets priced in slowly. Sudden drops happen when positioning breaks. When someone is forced to move, by late January 2026, silver had quietly become a crowded trade, not in headlines, but in positioning data. Too many hedge funds, too many leveraged traders, too many bets leaning in the same direction. Silver had risen earlier, confidence grew, and expectations became one-sided. When price approached a level where momentum stalled, it didn't need bad news to fall. It only needed buyers to hesitate. The moment silver failed to push higher, early money started exiting, not out of fear, but out of discipline. Liquidity thinned quickly. Orders became thinner. Stop losses triggered automatically. And once those stops hit, selling created more selling. Speed replaced logic. And charts began telling a story that headlines hadn't caught up with yet. No crisis was required. No emergency announcement was needed, just imbalance. This is how professional markets actually break. Not with panic, but with positioning. At the same time, another force was quietly pressing down: the US dollar. Strengthened sharply in early February 2026. Not because the economy suddenly became strong, not because debt disappeared, but because expectations shifted. Markets began pushing rate cut timelines further into the future. Money that had been positioned for easier policy adjusted quickly. Capital flowed back toward dollar-based assets. And when the dollar moves fast, silver feels it immediately. Silver is not gold. It's a smaller market. It's thinner, it's more leveraged, and it reacts faster to short-term flows. When the dollar spikes suddenly, silver doesn't argue. It reacts. Another detail most people missed: interest rates themselves didn't suddenly jump. What changed was belief. Belief about when relief would arrive. Belief about future liquidity. Belief about how long tight conditions might last. Silver doesn't respond to today's world. It responds to tomorrow's assumptions. When those assumptions shift even slightly, price adjusts immediately. And because silver trades with leverage, those adjustments look violent. Then came another quiet trigger that never makes headlines: ETF and paper market flows. In early February 2026, large silver ETFs experienced short-term outflows. Not because retail investors panicked, but because funds reduced exposure. This kind of selling isn't emotional. It's procedural. Risk limits get hit. Allocations get rebalanced. Margins get protected. Paper silver controls the visible price, even when physical silver doesn't follow the same behavior. And during this period, liquidity stress was building elsewhere. Equity markets showed increased volatility. Some risk assets corrected, and funds needed cash. When funds need cash, they don't sell what they hate. They sell what they can sell quickly. Silver is liquid. It trades almost around the clock. It converts to cash fast. So it becomes a source of liquidity, not a victim of disbelief. This selling wasn't emotional. It was mechanical. While charts were falling, something interesting happened in the physical market. Premiums didn't collapse. Availability didn't suddenly improve. Delivery times didn't magically shorten. The futures price reflected liquidity pressure. The physical market reflected slow-moving reality. These two often separate during stress, and when they do, it usually matters. This wasn't the first time the pattern appeared. History has seen it before. In 2008, silver fell hard before the real crisis became obvious. In 2020, silver dropped sharply before massive intervention followed. The sequence stays remarkably consistent. Liquidity tightens first, silver sells off early, policy response comes later, and silver recovers before headlines change. This doesn't mean prediction. It means structure repeats. Silver reacts to stress earlier than most assets. That's why it looks unstable. But that instability is information. So what did the February 2026 silver crash actually signal? It didn't signal the end of silver. It didn't signal failure of hard assets. And it didn't signal collapsing physical demand. It signaled tightening liquidity, stress in capital flows, and funds quietly reducing risk exposure. Silver didn't warn about itself. It warned about the environment around it. Silver is volatile by design. It's not meant to move smoothly. It's meant to react early. Those expecting calm price action misunderstand its role. Volatility isn't a flaw here. It's the function. The February 2026 silver crash wasn't a failure. It wasn't betrayal, and it wasn't weakness. It was a message delivered quietly before most people were listening.